some important things that we would like to explain in this video. Let's move to the concept of capital structure. What is capital structure? Capital structure is defined as the combination of debt and equity financing used by a firm to fund its operation and investment. The capital structure can significantly influence a company's risk profile and cost of capital, which are critical for strategic financial decisions. There are two primary components of capital structure. The first one is debt capital. This includes long-term debt such as loans or bonds with maturity greater than 1 year. Another example of debt capital is short-term bond, which due within 1 year or less. And next is equity capital, which consists common stock and preferred stock, where common stock representing ownership in the company and those holders entitled to vote and receive dividend, while preferred stock is a class of stock with preferential treatment in dividend payment but usually without voting rights. These are few examples of significance of capital structure. The first one is growth opportunities. The right capital structure can enable firms to pursue growth opportunities more effectively by optimizing funding for investment. And the other one is market perception. Investors often view a company's capital structure as an indicator of its financial health and risk profile. A balanced approach can enhance investor confidence and market valuation.
Assalamualaikum, my name is Marino Nabiyatirasa and I will continue with factors affecting capital structure. First is sales growth. The high rate of sales growth will enable the business to borrow money from outside sources and use more external funds because the earnings from this sale should cover interest and debt repayment. The higher sales growth, the higher the profit if company can control costs. Second is asset structure. Asset structure is the company's asset structure that describes the comparison of fixed asset with total asset owned by the company, which can influence the capital structure. Since having a lot of fixed asset will make it easier for the business to get outside funding, the model that must be used the higher the value of company's fixed asset. Third is liquidity. The liquidity ratio will assist the company in determining its financial progress, allowing to assess its financial condition and capacity to settle its outstanding debts. The higher the liquidity ratio, the higher the ability of the company to settle its outstanding debts. So last is profitability. Because its internal funding is sufficient to cover its investment needs, a profitable company will have a low debt ratio. If the company generates profit higher then the company's debt ratio will be lower. For example, I give it to you that when a technology started experiences rapid sales growth due to the success of its new product line, to scale production and expand its market reach, the company requires more funds, so it can either take on debt or issue new equity. Due to its high growth rate, it might choose to take on debt, hoping that increased revenue will cover interest balance and keep its equity dilution low. This example is for sales growth. That's all from me. Thank you.
Next, I will be explaining about the decision-making process. So, the first step we have determine capital needs for both new and existing projects. The company assesses both immediate and long-term capital requirement. The objective is to ensure that the company has enough funding to support both day-to-day operation and future growth opportunities. The second one, we have identify and establish resource limitation. Companies begin with internal resources like cash and retained earning to keep costs low. This is to maximize the use of available resources without overextending financial obligation. And the third one, we have established baseline criteria for alternative. Key criteria include keeping the WACC low to maximize return, ensuring flexibility in financing to support potential future projects, and considering tax benefit. The objective is to set standard to guide the selection of financing options that best meet the company risk and return expectation. Next, we have evaluate alternative using screening and preference decision. Companies compare debt, equity, and internal financing options based on their trade-off. This is to select financing options that align with their cost, risk, and strategic goals. And the last step is to make the decision based on a ranking of options that best fit the company's capital need and resource limitation. This is to choose the financing mix that best support the company needs while balancing risk, cost, and flexibility.
Now I will explain about theories of capital structure. Firstly, Modigliani and Miller-Jerome. This was one of the most important theories in corporate finance proposed by Franco Modigliani and Martin Miller in 1958. This theory states that in a perfect market with no tax or bankruptcy costs, a company's value is not affected by its capital structure. It also provides a benchmark against which real-rate durations such as debt costs are analyzed. For example, if Company A is financed entirely with equity and Company B has needs of debt and equity, then the total value of each company should be same. This theory has two propositions. Proposition 1 states that the firm value remains the same regardless of whether it is financed with equity or debt, while Proposition 2 states if company takes on more debt, equity investors demand higher return, but the total funding costs remain the same. So, there are two advantages of this theory. Firstly, clear foundation. It offers a theoretical baseline for understanding capital structure choices. Next, tax benefit insight. It shows how leveraging debt can enhance value through debt saving. Next is static theory, also known as static trade-off theory. This theory suggests that companies aim to balance the benefit and cost of debt and equity to achieve an optimal capital structure. A company's optimal capital structure is where the tax benefit of additional debt equal to the cost of financial distress. It posits that there is an ideal mix of debt and equity that maximizes a firm value. For example, a utility company might use some debt to save on tax, but will stop borrowing more once the risk of financial trouble become too high. So, there are two advantages of this theory. Firstly, practical framework. It provides a clear guideline for companies to think about debt and equity balance. Secondly, tax efficiency. It emphasizes the tax advantage of debt, which is relevant for many firms. Lastly, pecking order theory. This is a concept in corporate finance that explains how firms prioritize their sources of financing. It proposed by Stewart Simbiers and Nicholas Martinez. This theory suggests that a company should first use internal funds, then debt, and consider equity as the last option for financing. Firms prefer to use internal financing first, as it is least affected by market reaction and costs. For example, a profitable company like pharmaceutical firm might use retained earnings for research and development and expansion before turning to debt. So, there are several advantages of this theory. Firstly, reflect real practices. Companies typically use internal funds first, then debt, and only issue equity as a last option. Next is avoid market concern. Not issuing new share prevents signal that could lower stock prices. Lastly, save money. Internal funds have no cost, and debt is cheaper than equity due to tax benefit.
Next, I will be presenting on agency problems and how they impact the cost of equity. Let's look at an example. Blue Tech Corporation, a company that relies mostly on equity, which is money raised from shareholders, means that it has almost no debt. Without debt, Blue Tech Corporation managers don't feel much pressure to control spending because they are not obligated to make regular debt payments. Here is the agency problem that arises. Shareholders would prefer if Blue Tech Corporation used its cash to grow the business or return some of it to them. But since there is no debt to hold management accountable, this freedom sometimes leads managers to spend companies' money on unnecessary expenses instead of investing in projects that would help the business grow and benefit the shareholders. So, the impact on cost of equity is when investors see that management is not using funds wisely, they view Blue Tech as a risky investment. This leads investors to demand a higher return to compensate for the risk that management may continue to spend in ways that don't maximize shareholders' value. As a result, Blue Tech Corporation cost of equity will increases. In other words, it becomes more expensive for Blue Tech Corporation to raise new capital as investors expect higher returns to cover this risk. To conclude, this example shows how relying too much on equity with little to no debt can lead to agency problems. Without the discipline that brings, managers may spend more freely, which leads to higher equity costs for the company.
Now, I will present the signaling hypothesis part. The signaling hypothesis refers to a company's dividend payment that convey important information to investors. The dividend payment shows a company's financial health and prospects. Many investors seek higher dividends because companies with higher dividends have strong finances, while companies with less dividends might be seen as a sign of financial trouble. So, how does the signaling hypothesis relate to a company's capital structure decision? A company needs to choose between debt and equity to finance its operation. This can provide important information to investors who want to analyze the company's performance. Let's say that if a company decides to take on more debt rather than issuing new equities, it shows a positive signal about the company's future profitability, and investors are guaranteed to get further interest payments. On the other hand, if a company issues new stock, instead of debt, it may signal that the company is not consistent with future earnings, and investors do not get fixed payment like debt security does. In conclusion, capital structure is the mix of debt and equity that a firm uses to finance its operation and investment. Sales growth, asset structure, liquidity, and profitability of a company are the factors that influence a company's capital structure decision. Considering each step in the decision-making process to ensure an effective financing strategy that aligns with the company's goals. The pecking order theory is commonly used by companies because it aligns with the real-world behavior. Besides, company may prefer equity finance to reduce agency problems because equity doesn't require fixed repayments. However, investors may prefer to invest in a company that issues debt finance because they get sporadic interest payment. Hence, capital structure is important for a company because a good capital structure decision can help lower the company's overall cost of financing, and the sources of funds used by a company can increase the company's profit by giving higher returns to stakeholders. And that's all from us. Thank you.